First, it is a Monday, and you all know what that means. And if you don't know what it means, that means we are joined by Steve Rhodes. Steve Rhodes is the author of the Mastering Probability newsletter. He's also the host of the Trader's Edge on 11 a.m. Eastern Time every day that the market is open, right here on TFNN. Hop over here. This is the Mastering Probability newsletter. This is an extraordinarily thorough newsletter. You're going to get a lot of what you're looking for in that. Additionally, we love having Steve come on and give his analysis. I want to say as well is that Steve really interacts with the viewer. So if you have not checked out his show at 11 a.m. Eastern Time on TFNN, strongly recommend doing so. He takes questions, he looks at the equities you ask for, and it is a fantastic time. It is interactive. Strongly recommend checking out both Mastering Probability newsletter and his show, The Trader's Edge. Steve, how are you doing?
Checks in the mail, Jacob. Checks in the mail.
Thank you. I was working on it in the mirror, Steve.
I love it. I love it. So why don't we just jump right in? Because obviously there's lots of fear in our listeners out there, potentially, unless they're short. And let me just kind of go through slowly, what the charts are communicating to us. And the first chart that I wanted to look at is the monthly time frame for the S&P 500. And the top portion is price. The bottom portion is a tool that shows consecutive closes higher and consecutive closes lower. I'm going to show you what's going on in both sets. Let's start with the top panel. You'll see a green squiggly line on there. That green line is it's green or red. At this stage here, it's colored green, and that's referred to as the oscillator and change line. Now, when it's green, it tells us that the price oscillator, that's the difference between the 19 and 39 period exponential moving average of price, is above zero. When that's above zero, markets are considered to be bullish. Now, if we take a look at price behavior, and unfortunately I had to, because of computer issues, I'm showing you this in PowerPoint, so I can't point exactly to the month, but it looks like back in July, maybe of 2024, was the last time that we saw a close below that red oscillator and change line. Now, what we also saw once price gave that up, if you look down below, you'll see we ended up with 3 consecutive months to the downside. So we're below the oscillator and change line right now. Odds last month was, even though it was a small lower close out there, we actually made a higher high. We made an all-time high last month, and then there was just really a doji style candle. So it wasn't anything significant, not like this month. So if we look at prior consecutive moves to the downside, the last one, as we just mentioned, was a 2-bar move. The one before that was a 2-bar move. One before that was a 2-bar move. One before that is a 2-bar move. Most moves in bullish markets tend to be 2-bar knee-jerk reaction lows. So what that says is there's the potential in the month of March for there to be a bottom. Mm-hmm. But I would also say it's 2 to 4 bars out here. We see mostly 3-bar moves. In fact, I don't see any 4-bar move going back to 2011. So that's 14 years out there, just 2 or 3 month moves to the downside. Any questions about that?
No. Please keep going. This is interesting stuff.
Perfect. Okay. So this suggests a 2 to 3 month move to the downside, with the emphasis right now perhaps on 2. If we go take a look at, now that was just, I had blown up the S&P 500 so the folks could have a decent understanding of how to use those tools on my chart, and then what does that mean for the rest of the cash indices out there? Well, you can see we really have the same basic setup. The Dow is below its green oscillator and change line. The NDX 100, the same thing. The Russell as well. The semis have been below the oscillator and change line for months out there, but just been trading sideways. So we've got that same condition, generally speaking, overall for the markets. You can see last month was bar number 1. That's the red numbers on the bottom portion of each of the charts that you're looking at. So a 2 to 4 bar move to the downside, knee-jerk reaction low, is very likely unfolding as we speak right now. It's consistent throughout the charts. And that says price is likely to pull back to support. So I want to kind of start moving towards a support thought process here. And this is the S&P 500. We look at the S&P 500 a different way. Yep. And this here, you'll see these red horizontal lines. Those red horizontal lines are what we call horizontal trading ranges. It turns out, it was taught to us by a guy named Bud Rolfs, goes back 15 years ago. Here at TFNN, and what this is doing is this is identifying the largest number of co-located opens or closes. When I say co-located, it can be either an open or a close of a candle. It's also where I say the body of the candle is really truly the essence of price, not necessarily the wicks of the candles. But that's a different thing. So what this does is this automatically goes out there, identifies the largest number of sequence of co-located opens and closes. That identifies the second largest, and that becomes the spacing. Once you have that identified between every price level that's added here. So there's equal spacing. Somebody can do the math on it. They'll see it's going to be basically exact out there. Now, what's interesting about and then I've also got in there rising price channels. So I have a rising price channel. If you take a look at the green lines, that starts back at the lows for 2009. And once that created the bottom. Right. Once you are able to identify a top, which is the dashed green line out there, that also gives you the price distance between high and low. And so each of those other diagonal lines to the upside were established by what was created at that bottom line area. Here what we see is in the S&P 500 found resistance at 6102, and right now is testing support or maybe just slightly below support at 5630. If price moves down from there, the next level of support would be the green rising price channel, probably around the 5500 type area out there. But nothing has really been broken just yet. And all the moves that we're looking at, just kind of normal out here with regard to moves to the downside. So that's the cash indice for the S&P. This is the same set of charts except for the Dow. Monthly time frame chart shows the rising price channel, shows the horizontal trading ranges. The next potential support level for horizontal trading range for the Dow is at 34,934. And if we take a look at the NDX 100, we can see, again, same set of charts out here, rising. This also shows the rising price channel off of the 2020 bottom out there. Those are these dashed green lines out there. So these all become potential support areas. The next one to the downside in the NDX 100 would be 18,099. This chart here, at least as of 15 minutes ago, what we look at is the second from the bottom panel. That's the advanced decline oscillator. And that's established by taking a look at the difference between the 39 and 19 period moving averages of the advanced decline line. That's the second section out here. When this gets to minus 150, we were at minus 145 about a half an hour ago. That tells us we are getting into oversold conditions. Yes. The type of oversold conditions to expect or anticipate some type of bounce or bottom. Now, the market can get more oversold than this, but we're now entering oversold territory. A lot of discussion, right, about the Trump tariffs and what might all that mean, and what's that mean for the market. Well, let me tell you what it means for the spot VIX index, or the VIX index traders out here. They're saying this is a short-term event.
Okay.
How do we know that? Well, if we take a look at the spot VIX index, again, a snapshot from about a half an hour ago, you'll see that's trading at about 2801. Down below here, I've got all of the forward future contracts taking us out to November of this year. Take a look at the price point. This is contango. This is not a normal, natural way that the VIX trades out here. This is all short. Look at here's the March volatility. So you're at 2450. Come all the way back to November 2025. You're at 2067. All the forward future contracts are trading below the spot VIX. That tells you to really expect and anticipate quite a rally. I'm not saying that it's the bottom. But this is so important to understand.
Steve, are you able to stay right there into the next segment? Please do.
Can do.
Perfect. Folks, stay right there. We'll be right back with Steve Rhodes after the break. Welcome back, everybody. We are joined right now by Steve Rhodes, author of the Mastering Probability newsletter, host of the Trader's Edge on 11 a.m. Eastern Time, right here on TFNN. Steve, before we went to the break, okay, you're looking at some stuff here. This is really interesting. With the data you're looking at, you might be seeing the potential for a bottoming or a bounce going on. Could you explain that? Maybe go over it, briefly one more time and kind of expand upon it.
Sure. So there's the VIX offers a number of really great tools to help us interpret what the markets are doing. The one that we're using right now, and people will get focused on, they hear what the spot VIX is and they say it's 28, and they think it's elevated and all that type of stuff. But what they're not doing typically is looking at what the future VIX contracts look like. Because that's really important. If, for example, this was going to be a sustained move to the downside, you would not see, for example, the May VIX trading at 2162 with the current VIX at 2450. It doesn't work like that. This is a gigantic, huge contango. Again, this is telling you this is all short-term issues, right? What we're seeing here in the market, now, as you know, things can change on a dime.
Yes.
But right now, we've got to interpret the charts, the messages based upon the information that's provided to us. So we know a couple things. We know that we are approaching the oversold market condition using the advanced decline oscillator tool out there in the minus 150 level. So that says, okay, be on your toes. Then we take a look at spot VIX index and see that 1 year out, there's a tool that that they provide. 1 year out for the spot VIX is trading at 23.93, and we're at 28.01 today. Gigantic percentage. Now, speaking of percentages, there's another great second use for the spot VIX, and that's called the one-day rate of change. And that's the very right column out here. Now, look, when I took this snapshot half an hour ago, it was at 1985, a 19.85% one-day rate of change. I don't know where it's at right now. But what I do know is if the one-day rate of change is about plus 10%, that's another element to suggest that we need to look for at least some type of short-term bottom. In that case, typically overnight, I would say it either starts usually around the Asia session, around 8, 9 o'clock, or maybe it's the European session. Of course, daylight savings time, you got to figure out all the hours on that one. So that's a spot VIX. Sure. This line here, remember we've talked about how when major market tops form, it'll do so for all international for the major primary international instruments. Yes. This is a snapshot from a half an hour ago. Look at the center chart. That's the DAX. The DAX was at new all-time highs on Friday. Yep. Out there. Yep. You know, it's hardly budged. It's not suggesting anything like 2000 or 2007. At least not just yet out there. So that's another piece of information to take a look at. Now, when I take a look at the equity future contracts, these are the daily equity future contracts. The green lines, the green horizontal lines here are weekly profile levels. And I'm showing here on the ES Mini both the center and the bottom. When the top was way up here, I didn't want to really cloud up everything. Price is pulling back into a very strong level of support. No guarantee that it's going to hold, but 55.96, 55.96 to 56.37 is a very strong area of support. In the case of the NQ, it's between 19.191 and 19.392. So those two instruments are getting back to strong support levels. We'll have to see how they're handled. In the case of the Russell 2000, you can see an A to B equals CD pattern to the downside. That's completed the 1-to-1 price objective. It'll continue to move lower, but a bullish reversal candle would confirm a buy the D point pattern in the Dow. The Dow out here is below support. I don't have any on this set of charts here. I don't have any support for it, but that doesn't mean you know what? So I was running into those system problems. Some of those other charts didn't. But here's what I can do. I've got another game plan. Let's do this. I've got a game plan which says let's go take a look at this chart right here, which is the S&P 500. Yeah. So. I can't go back to do the Dow, but let me try to give you some ideas also with regard to the S&P 500 out here. On a weekly time frame, boy, yeah, those system problems, they really kind of screwed things up. On the weekly time frame, what we were looking at is a consolidation. And right now you can see we are trading below that consolidation. This is a weekly chart. So it doesn't necessarily matter what it's doing on a Monday. It matters where it closes on a Friday. But right now, let's assume that we're going to break the consolidation. If on Friday, this is what the candle looked like, what you would do is you would basically get a consolidation measured move. And you could take that consolidation, you move it towards the bottom of the consolidation, and that tells you about where you're going to go target. Interestingly enough, on a weekly time frame, the level where price broke out from is at 53.2437, right to the T. How do I know that? Well, that uses the TD9 count system to identify where price breaks out from and where price breaks down from out there. So it's a very objective level. It's not something that Stevie created or tried to teach you anything. All I have to do is teach you the TD9 counts, and then you'll be able to identify where these levels of support are. So in the case of the S&P 500, in lieu of any kind of other daily bottoming signal forming out there, this says, so I want to be clear on what I'm saying. We had those other charts that suggest anticipate and wait, and that there's likely to be some type of rally. I still believe that. But then on the larger interpretation, I don't know that the rally's really over. And in fact, not until the monthly time frame chart were to get above that oscillator and change line at 58.85 would I be comfortable in saying that. Or if we got a 2 to 4 bar move to the downside on the monthly time frame chart as we're getting bottom signals on the daily and the weekly. I hope that made some sense.
Yes.
To just kind of takes things one step at a time. If I were to look at if I go down and take a look at, if if I take a look at the intraday charts here for the NQ. So this is interesting. And again, we're looking at the daily charts at the bottom portion. We got the 10-minute, 15, 30, and 60. So I want to give a real play-by-play here. And here on the 10-minute time frame chart, Tom's favorite time frame, by the way, this formed a Rhodes Momentum Indicator bottom pattern at 330. And price right now is taking on profile resistance. It's a little bit of a sell zone. It's a 10-minute chart. This pattern is going to this bar is going to complete in 2.5 minutes out there. And if it closes above 19,477, that says that it should rally even further out there. In the case of the 15-minute time frame chart, a Rhodes Momentum Indicator bottom pattern, both of those being confirmed by bullish reversal candles. In the 15-minute, it was a three-river morning star pattern out there. You can see the 120, the 240. They've got Rhodes Momentum Indicator signals. Those need bullish reversal candles to confirm some type of intraday bottom. The reason I've switched over to this is we're looking for consistent bottoming signals that spot VIX one-day rate of change above plus 10%. You want to find on some type of time frame, whether it's 30 or 15-minute time frame, where each chart has a bottom signal, and then the market should rally from there. But this may not take place, folks, until the real overnight hours, which might be around 2 or 3 in the morning.
Fantastic. And folks, this is why now is a fantastic time to check out this newsletter. I mean, Steve, I'm definitely going to be following along on this, right? I mean, with these kind of conditions are hit, and say we make a legitimate, technical bottoming pattern, I mean, hey, you've kind of got to reposition yourself and see what happens. Thank you.
Absolutely.
Do you want to look at Tesla?
No, that's okay. That's okay.
Fantastic.
Set up for
well, then let's look at it tomorrow at 11 a.m. Steve, thank you so much for coming on.
You got it. Take care.